Welcome to the deep dive video update. This is a video that I do over the weekend where I go back and I look through all of the charts that I use throughout the week in the daily video updates. And I take those charts that I didn't use and I put them into this video. And there are also some additional charts that are unique just to this particular video. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. This is being prepared from Monday, May 19th. This is a chart that I just used in this video. It's a long-range look at the VIX itself, and the VIX is on this chart, but it's invisible. Over top of that is a 50-period exponential moving average. This gives us an idea of the overall range of the VIX, and even though we've been coming up and we were getting close to that 20 level, we're not there yet. And now with the market starting to go back up, you can see how this is rolling over slightly. So this is still more positive than anything else. But again, we don't use this to make decisions. This is just for informational purposes. Also, we look at the VIX and then a correlation with the S&P 500. I only pay attention to this chart when it's above the dash line. We're still getting quite a low reading with this chart. Then we look at the VIX and do a ratio with the VVIX, or the volatility of the VIX, and it had been going up as well, according to the 50-period moving average. Now it's starting to roll over as the S&P has been going back up. The SKU Index, I only pay attention to this chart when we're up in the red area. We're now more neutral currently, so we're not getting any additional insight here. The Ulcer Index, which had been in the daily video for quite a while, when it drops below the moving average, that's when I stop using it in the daily videos. And this is another fear gauge. And as the S&P has been going up, fear has been coming out of the market. Then we look at the volatility of stocks measured by the VIX and the volatility of bonds measured by the MOVE index. And as stocks have been becoming less volatile lately, that's sending this ratio down, and the red line is starting to roll over as well. In this context, that's more positive. The bond market, interest rates have been going back up, and that's a little bit of a concern. But as stocks have been going up, they really haven't paid attention to the rise in interest rates unless we get above that 4.5% level with the 10-year yield. So this overall trend has been down. I mainly follow the red line on this chart. We look at a ratio between large caps and small caps. Large caps are represented here by the Russell 1000, and small caps are represented by the Russell 2000 index. And we're just kind of chopping along right now. When this ratio is going up, which it pretty much has been doing, even in 2025, as stocks have been under pressure, well, the large caps have held up better than the small caps. Lately, we've been just chopping sideways with this overall ratio. Then I added a new part to this chart. This is just for information. Based on Friday's close, we're up 70.5% from the October 2022 low. Then we're up 45.19% from the October 2023 low. And right now, we don't know if this is the yearly low, if it's a major low, because we could always come back down and test this again. But as of right now, we're up 23.23% from the April 7th low. Then stockcharts.com, every day they come out with technical alerts. I use the predefined alerts that usually focus on indexes and sectors. And these are all of the alerts that were triggered throughout the week. We start on the bottom with Monday. And that was when we saw the gap higher after the trade deal was announced that lasts for 90 days. The market really liked that. We gapped up, and that's really where we got a lot of the gains, was from the gap up in Monday's session. And then it's also rather impressive that we were able to hold on to those gains. So we saw an awful lot of green in Monday's session. Then we started to see a little bit of a shift as growth has been outperforming value and starting to actually improve and take more of a leadership role. That's where we see some of the more defensive sectors starting to show some weakness and growth areas showing some strength. Canada set a new all-time high on Friday, and the Nasdaq was able to get above 19,002 in Friday's session as well. But the way I use this particular chart is we just say, okay, if we see a lot of green, that's positive, red, that's negative, and then a lot of times we'll see a mix. That just shows there's a shift going on in the market. Then I also look at 6 indexes and rank them on a scale of 0 to 100. The higher the score, the better looking that chart. And we're seeing a real improvement here with the QQQs. This is the NASDAQ 100. It had really been suffering there for a while. It was down into the 20 range, and it's looking about the best. And it's really showing some improvement, coming in at 81.8. Then, not far behind that is the NASDAQ Composite, and that's coming in at 76.6. Then in third place, we have the SPY, which is the ETF for the S&P 500, showing some improvement here, not as strong as some of the more growth-focused areas. The S&P is growth and value together, and it's coming in at 65.2. Mid-cap showing some improvement here. A little bit of a higher score coming in at 41.6. These are still not great scores. We want these indexes to be up in the high 80s, low 90s to show that they're really strong. Then we have the Dow. It actually fell a little bit. Even though the Dow is now positive year to date, it actually went positive on Friday, and it was able to close above its 200-day moving average. It's considered to be the best of the best stocks, and they've been languishing. And a lot of that has been pulled lower by United Healthcare and problems going on in that company. And then last place, but at least into double digits now, where we had been in single digits, are the small caps coming in at 12.9. Still looking pretty weak. You'll have some folks that'll try to get into this area thinking that they're buying a bottom. But we've seen that over the last couple of years where the small caps, they look promising, they start to do well, and then they just stop. And they end up giving back most of their gains. We're still below the 200-day moving average with the small caps. And so if we can get back above that, that would help this score improve quite a bit. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Here is a short-term rainbow, and it's plotted here with simple moving averages going from 10 periods up to 50 periods, and we're seeing a real improvement in the short term. We're back above the rainbow, and we've been staying above this rainbow, so now the lines are starting to turn up. We were really headed down there with some real conviction, but we've been able to bounce up after we hit some really solid support, long-term support. And so the longer we stay above these lines, the more they'll continue to go up, the more they will smooth out and look more like an uptrend. This is a little bit longer rainbow, intermediate term, going from 50 periods up to 100 periods. We didn't spend as much time below this rainbow, but it started to roll over. But now that we're going back above it, we can see the lines are trying to turn back up. And the Bollinger Bands, we're not getting an extreme reading here. I just use this with a thing called the percent B indicator. That just measures if we close above or below the upper or lower Bollinger Band. We're not doing that right now. That's when we really focus on this chart. It is positive from the stance that we are above the midpoint here. Then this is just some measurements that we take going back to the low set in 2023 and where we're at right now on a percentage basis, a little bit over 30%, almost 31%. And I do this eyeballing, so these percentages, you just move this a little bit and the percentages change really quickly. So they're not necessarily all that accurate. I just use them as a guidepost here. What was interesting, though, is when we set the high in February and then we declined on an intraday basis, we were down over 21%. Now, if we had closed there, that would be going into a bear market. Now, we're still in a downtrend with the S&P, but we have been bouncing back up. And we're back above the 20, 50, and 200-day moving averages. So we're actually looking more positive that way, but we still haven't seen the trend switch from down to up. And we're making a nice little bounce back up here after hitting those lows in early April. Then the Connors RSI, which is an oscillator, we look for extreme positive or negative readings. We're getting close, but we're not above this black line yet. I only show this if we were to go up above this upper black line. Anchored moving averages, we used these a lot when the market was heading lower to try to find areas of support. And then as we've been coming back up, areas of resistance. Well, we've been able to break above all the anchored moving averages that are on this chart. And so we're seeing these moving averages start to smooth out a little bit. And again, just like with other moving averages, the longer we stay above these lines, the more they'll smooth out and actually start to turn back up. We want to keep an eye on the S&P 100 and its relation to the S&P 500. The S&P 100 are the biggest stocks that make up the S&P 500. Not really seeing any much of a disconnect. We're on some of our ratio charts, we are starting to see where the S&P 100 is still in an uptrend. Hasn't been performing all that well compared to the rest of the S&P, but it is improving. Then we look at a 10-day average of the highs and lows for the S&P. This is pretty long term. We had become quite negative. Well, we actually turned positive with this chart when we went back above 50, and now we're up in the 72 range. We use this like an oscillator if we get all the way up to this green line, which would be at 90 or above, and that means the market is either showing really good momentum longer term or becoming overbought. Mass index, we did get a signal here that was trying to tell us that we might get some kind of a reversal. And since that time, we've really dropped off and we're far away from getting any kind of a signal here. We also had, this has turned out to be pretty good, but we only know this really in hindsight because we get a lot of bad signals from this indicator too. It's called the Prime Bottom Fisher. We crossed over positive back in April, and that would have been a good signal. You would have been scared to death a few times because you would have got in and then saw some pretty significant declines after that. So if you set up stop losses, you probably would have got taken out. But if you'd been able to ride this out, then it eventually recovered and you would have seen some pretty good gains based on this chart. But I never used this chart independently. And we were getting a lot of mixed signals. There was a lot of emotion. We didn't know what the news was going to bring. And with the tariff announcements and the trade deals, and it was for anybody to go back and say, oh yeah, I should have bought right here. It's almost impossible. Your emotions would have just kept you from wanting to do anything because at that time, usually we become contrarian indicators when we're looking as negative as we were. But there were so many variables out there with what was coming out of the White House, it was almost impossible to make a decision. All right, then we have another long-term rainbow. This is also simple moving averages going from 50 periods up to 250 periods. And we didn't spend a lot of time below the rainbow, but it did start to roll over. Now we're back above the rainbow, and this is improving the long-term trend. This is a chart that I mention in every daily video, but I only show it in this video. It's a special K. It's a long-term oscillator. And I don't show this chart because we don't get very many signals. We might get one or two a year. We are negative with this, but we're starting to turn back up as the S&P's been going back up, and it would be even more positive longer term if we eventually came back and crossed above this red line. And we look at a weekly chart of the S&P, that's US stocks, and then the German DAX, which Germany has the biggest stock market in the EU. And we look at the correlation, and it's pretty neutral right now. Even though Germany's been doing well, the US has been doing well, the correlation hasn't really kicked into gear. They haven't really been following each other. We saw a real disconnect earlier on when European stocks were going up and US stocks were going down. And now people kind of caught on to that and they're starting to shift over to markets outside the US. Well, again, from a contrarian perspective, when that happens, it usually means the party is either over or just about over because it's looking a lot more positive. Now, anything can happen with stocks, but US stocks are at least trying to make a comeback and looking stronger right now. Then this is a mini rainbow, and it's based on short-term moving averages. It's a moving average of the open, high, low, and close. And I developed this indicator decades ago, And I just kind of kept using it because I found that sometimes when we are below the rainbow and then we start to bounce back up, one of these lines may act as resistance. And when we're going up and then we fall back, one of these lines will quite often act as support. Well, we're far away from the lines and the lines are going up, so I haven't been showing this chart, and it's more positive because we're seeing all the lines turning and going higher. Then we were really focused on this. This is a shorter term Fibonacci retracement chart drawn from the February all-time high, and then it went down to the April 2024 low. That was a low that was set just a little over a year ago. And there's other Fibonacci charts that are longer term that ended up just pinpointing the exact bottom that we set. This one was helpful. We were watching things on the way down. We did find some support here at the 50% retracement level and then couldn't stay above the 61.8% retracement level. And then we fell all the way down, actually fell down below the 100% retracement level. We actually gave up all the gains from a year ago, but that was about where the bottom was set. And another Fibonacci chart picked out this absolute bottom right here. And since that time, we've been going back up and reclaiming some of these areas. We did see the 61.8% retracement level a week ago. This was providing overhead resistance. And then with the positive open on Monday after the news came out about the trade deal, that's when we gapped higher and we've been able to reclaim a lot of these retracement levels. Then looking at the broad market, this is the VIXen, which is the volatility measurement for the NASDAQ 100, where I mainly focus on the VIX, which applies to the S&P 500. I don't use this chart all that much, but I do keep an eye on it. I look at it every day, but I don't talk about it all that much in the videos because I mainly focus on the S&P 500. And we look at a ratio between the S&P on top, and then the ratio down here is growth, QQQs, to value, the diamonds or the Dow, even though there are some growth stocks in the Dow. And then we look at a correlation between the two. And we're seeing that the correlation is pretty strong. That just means that growth is doing better and showing some improvement. We had been seeing this correlation dropping off, even though it really never turned negative. It's now showing a little bit more strength. And we look at the Dow and the transports. The transports are still lagging. They're trying to make a comeback here. That's the red line, but they still continue to underperform the Dow. And the Dow hasn't done all that well. It's just getting back above its 200-day moving average. We want to keep an eye on the financial sector, and one area of the financial sector are the banks. We are in a downtrend here with the blue line below the red line, but we were able to get back above the 200-day moving average. We saw the nice gap up in Monday's session, but then we've been just treading sideways, but at least we're not seeing a lot of declines right now. Another area is not only do we want to watch the bank ETF, we want to watch the regional bank ETF. These are the smaller banks, and they're more vulnerable to interest rates, and like Silicon Valley Bank, Republic Bank, New York Community Bank, banks that have had problems over the last year or two. So we want to keep an eye on this ratio between regional banks and the financial sector. It's still underperforming. It's in a downtrend, but we are seeing some improvement. So it's not necessarily falling apart. And the financial sector itself is doing quite well right now, and that's a positive thing. Then we just look at a ratio between U.S. stocks and German stocks. When this ratio is going down, that's while German stocks were outperforming. And then we saw U.S. stocks going up and starting to outperform, and now we've pulled back and we're just kind of chopping sideways. We don't know if this ratio, this relationship will continue, but a lot of people they finally found out about it. And again, if this continues to go back up, that means that they're kind of timing things just about at the wrong time. Then this is for informational purposes. These are long-term rate of change charts, two charts that show 250 periods where we actually dropped down below zero and we've been bouncing back up. So longer term, we're improving. And this goes back all the way to 1980. We also dropped down below the midpoint and we've been coming back up. This just shows some strength is coming back into the long-term trend. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, Explore the SPX investing program and start with a 30-day free trial. And we want to keep an eye on bonds. And I've really been watching this. And we can kind of try to figure out how concerned is the bond market about inflation and interest rates. And when this ratio is going up, we compare cash to the 3 to 7 year bonds. This means there's uncertainty about interest rates and inflation. Well, we've actually been coming down. We've been chopping around, and we're not really seeing a lot of conviction right now. But this would suggest, at least in the short term, when we look at cash to 3 to 7 year bonds, that the bond market still is not all that concerned about inflation. We do that again using Treasury inflation protected securities. This is what an alternative that people get into when inflation's going up and interest rates are going up. They get into tips. When interest rates have stabilized and they're not really concerned about inflation, then they jump over into 3 to 7 year bonds. And we're actually in a downtrend here, showing how the tips are underperforming, but lately they've been coming back. There's concern about inflation, and we've been keeping an eye on this chart for quite some time, but we're not really seeing a lot of concern from this particular ratio. If this continues to go up, yeah, that would suggest that the bond market is more concerned about inflation. But we've been just kind of chopping around and in a downtrend overall with this ratio. So the market's not really concerned with that. And we use that same basic idea, but we look further out. We look at tips with 7 to 10 year bonds. This has been going back up and is still in an uptrend. If this continues to go up, then that will cause some concerns about inflation, especially if interest rates keep going up. And we look at that same idea here, but we compare the long-term bond, which is in blue, and compare it with the S&P 500, which is in red. And we look at the long-term correlation, where it's actually starting to decline, and the short-term correlation suggests that they're going in opposite directions. So if stocks are going up, bonds are going down. And that's kind of what we've been seeing over the last week is bond prices have been under pressure. That means interest rates have been going up as the S&P has been going up. That same approach is used with the QQQs, which is growth, compared to the long-term bond here in red, the TLT. And their long-term correlation right now is pretty much neutral, but it is starting to get weaker as we're seeing them move in slightly opposite directions from each other. All right, and this is kind of a funky little study that I ran across a few years ago. You take the 10-year yield and you subtract in the US and subtract the German 10-year yield. And since US rates are higher, we get a positive answer. And then you plot the US dollar index down here. And actually, there's a pretty strong correlation. This shows international interest rates compared with the currencies. And even though it's coming down, we're still in this blue area showing that the correlation is fairly strong between the top chart looking at interest rates and the middle chart, which is looking at the US dollar index. We want to keep an eye on the 2-year Treasury yield. I also watch the 3-month yield as well. And we have been making a series of lower highs here, and that could actually be more positive for stocks. But a lot of times what we see is when we spike and then start to come down, that can give short to intermediate term support to stocks. Really hasn't had that much of an impact as much as it was a few years ago. We want to keep an eye on the 10 to the 2-year yield curve. It's normal. It's above zero, so it's above this blue line just because it was inverted for a long time. And then when it goes back to not being inverted anymore, that's when we start a countdown. And by I say countdown, it could be 3 months, 6 months, 18 months, 2 years, who knows? But this is when we just kind of raise our radar to say, okay, are we going to in fact go into a recession? And most people use this, the 10 to the 2 yield curve. I also follow the 10 to the 3 month, and it's kind of right on the border. It's not inverted now, but it was inverted for quite some time. Then it went back to being regular, and then it was just kind of bouncing in and out of being inverted, uninverted. Well, right now it's not inverted. We just are keeping an eye on this one. And this is a newer chart to the video anyway. We're looking at energy, which has been under a lot of pressure, and we do a ratio to the 10-year bond here. And we haven't really seen, I haven't shown this chart because it's really not showing us all that much. When this ratio is really going up, like we saw back in 2021 into 2022, that means there are inflation concerns. Lately, we've been pretty much going sideways as a lot of those concerns have been able to subside. And just to compare apples to oranges here, we look at European stocks and then US bonds. And European stocks are outperforming as they're seeing some recent strength as well. And then I have some things called possible positive scenarios. I only use them usually when we're going down, but none of them became really extreme negative here. This is the percent of stocks in the S&P above their 200-day simple moving average. We look for extreme negative or positive readings. We're not getting that. Then we'll use this to see, okay, what's the longer term bias? If we're below 50, that's negative, which we were. Now we've been able to come back above 50, and so the bias is switching back and looking more positive. Then we do that same thing with the 50-period moving average for the S&P or above 50 and going up, but not extreme. Mid caps above 50, going up, but not extreme. And small caps they're improving. They just have so much damage that had been done, and they're lagging behind a lot of the other indexes, but they are showing some improvement here looking at this chart. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.